All right, let's dive right in. Today, we're going to unpack one of the most important financial innovations of the last 30 years, the Exchange Traded Fund, or ETF. I mean, they're everywhere now, right? But how do they really work? And more importantly, how have they totally reshaped the very structure of modern investing? So, to really get a sense of just how big this is, think about this number, $10 trillion. The global ETF market has ballooned to over 10 trillion. That's bigger than the entire economy of Japan, Germany, and the UK combined. So yeah, this isn't some niche corner of the market. We're talking about a true financial behemoth. But here's the crazy part, right? Even with all that money sloshing around, most investors don't really get how ETFs work under the hood. They just see them as simple baskets of stocks. But in doing that, they miss the absolute genius of the core innovation, and they definitely don't see the hidden dangers lurking in the more, let's say, exotic types. Okay, so let's blow past that simple surface-level definition. We're going to peel back the onion here and look at the actual mechanism that makes an ETF so fundamentally different from every investment that came before it. This is where it gets really interesting. Now, you've probably seen this definition 100 times. And look, it's not technically wrong, but it completely, and I mean completely, misses the point. The real magic, the secret sauce of an ETF, isn't about what it holds. It's all about how it's built, and specifically how its shares get created and redeemed. Okay, so you see this chart here? I want you to focus on that third row, redemptions. This is where the magic happens. See, with a mutual fund, if you want your money back, the fund has to go and sell stocks to get your cash. Simple enough. But an ETF, it does something totally different called an in-kind exchange. It's swapping actual stocks for ETF shares. This might sound like a tiny, boring detail, but trust me, this little difference is the key to everything. Okay, this is the secret sauce I was talking about. You have these big players, these massive financial institutions called authorized participants, or APs for short. And when they want to create new ETF shares, they don't just hand over a pile of cash. No way. They go out, buy the actual stocks the fund is supposed to own, and deliver that whole basket of stocks to the ETF provider. In return, boom, they get a fresh block of new ETF shares to sell on the open market. And it works the same way in reverse for redemptions. Now, what does this all mean? It means the fund itself almost never has to buy or sell its underlying stocks. And that leads to this huge and, honestly, mostly overlooked advantage. All right, forget low fees for a minute. Everyone talks about low fees. But for anyone investing in a normal taxable brokerage account, the tax efficiency that comes from that in-kind process, that is arguably the single most valuable part of an ETF. Let's break down why. So picture this. You're in a mutual fund, and the market gets rocky. A ton of investors get scared, and they all want their money back at once. What does the fund manager have to do? They're forced to sell stocks to raise cash. Now, if those stocks have gone up in value over the years, selling them triggers a capital gain. And here's the kicker. That tax bill gets passed along to everyone still in the fund, even you, even if your own investment is down for the year. You can literally lose money and still get hit with a tax bill from the IRS. It's insane. And this chart right here, it just lays it all out plain as day. So in 2023, Morningstar found that a whopping 65%, almost two-thirds, of mutual funds stuck their investors with a capital gains distribution. And ETFs, a tiny 4%. Why the huge difference? It's all because of that in-kind redemption process. They just don't have to sell stocks, so they don't create those taxable events. I mean, from a design perspective, it's a structural masterpiece. Okay, so what does this all mean for your actual money, for your bottom line? Well, over a long investing horizon, say 30 years, just by choosing an ETF over a similar mutual fund in a taxable account, you could end up with, get this, up to 19% more wealth. And that's not from better performance. It's purely from avoiding those little tax bills that bleed you dry year after year. That is a total game changer. Okay, so we've established the structure is brilliant, right? But, and this is a big but, not all ETFs are created equal. The name ETF is really just the wrapper, the container. And inside that container, you can find a whole universe of strategies, from the super safe and boring to the incredibly speculative and dangerous. So let's take a look at that risk spectrum. So at the top, you've got your basic equity index ETF. Its main risk is just, the market going down. Pretty straightforward. But as we go down this list, things get a lot more complicated.
Sector funds? Now you've got concentration risk. You're putting all your eggs in one industry's basket. Bond ETFs? They can have a really nasty liquidity mismatch problem in a crisis. Commodity ETFs deal with futures contracts, which have their own weird performance drags. And then you get to the really spicy stuff.
Chasing the hot new thing can absolutely wreck your portfolio. Just look at the ARK Innovation ETF. Everybody piled into it during that 2020 tech mania, and what happened? It crashed, down 78% from its peak. And during that same time, the good old S&P 500 was basically flat. That's a perfect, painful example of thematic concentration risk. Now, I really need you to pay attention to this next part, especially this quote. When we're talking about leveraged and inverse ETFs, this is dead on accurate. These things are built to give you 2 or even 3 times the daily return of an index. But here's the trap. Because of how they're built, something called a daily reset, their long-term performance can get totally unhinged from the index they're supposed to track. The constant up and down of the market can just grind your capital into dust over time, even if the index itself goes up. Let me say it again. These are not buy and hold investments, period.
Okay, so now that we've seen the good, the bad, and the really ugly, how do we actually use these things smartly? Let's shift gears and talk about a practical playbook to make ETFs work for you, not against you.
First up, think about a core satellite strategy. The core of your portfolio is made up of broad, cheap index ETFs, your foundation. Then you can use smaller, specialized ETFs as satellites. Second, always maximize that tax advantage. Put your stock ETFs in your taxable accounts. Third, ETFs make tax loss harvesting super easy. Fourth, and this one's a big one, always trade using a limit order, not a market order. That way you control the price you pay. And finally, just be careful with those really small ETFs, say under 50 million in assets. They have a much higher chance of just being closed down, which is a headache you don't need. Look, at the end of the day, an ETF is just a tool. It's like a hammer. A simple, low-cost index fund ETF, that's a fantastic tool for building a solid house of long-term wealth. A triple leveraged oil ETF? Well, that's more like a stick of dynamite. The tool itself isn't good or bad. The outcome really depends entirely on the skill, the strategy, and the discipline of the person using it. When you step back and look at the big picture, ETFs really did democratize Wall Street. They gave regular people like you and me access to markets and strategies that used to be only for the big dogs on the street. They've brought costs way down, and they've massively improved tax efficiency. So, the only question left is, how are you going to use them?